that helped lead to the financial crisis in 2008. This is just under an hour.
Good morning. I'm pleased to join with Secretary Shaun Donovan, Attorney General for the State of Iowa Tom Miller, Associate Attorney General Tom Pirelli, the Director of the Consumer Financial Protection Bureau Richard Cordray, HUD Inspector General David Montoya, and the Attorney Generals for the State of Colorado John Suthers, for Illinois Lisa Madigan, and for North Carolina Roy Cooper, to announce our latest step forward in righting the wrongs that led to our nation's housing market collapse and economic crisis. Today, the Departments of Justice and Housing and Urban Development, along with 49 other state attorneys general and other federal agencies, have reached a landmark $25 billion agreement with the nation's 5 largest mortgage servicers: Bank of America, J.P. Morgan Chase and Company, Wells Fargo and Company, Citibank, and Ally Financial, which was formerly GMAC. This agreement reflects our commitment at both the federal and state levels to ensure justice and to recover losses for victims of reckless and abusive mortgage practices. In addition to addressing many of the most egregious mortgage loan servicing abuses that our investigations have uncovered, this agreement establishes significant new homeowner protections to help prevent future misconduct. It also provides substantial financial assistance to victim borrowers. In fact, it is the largest joint federal-state civil settlement in the history of this nation. Now, although every American can be encouraged by today's settlement and the progress that it achieves, I realize that more work must be done. That's why we have taken steps to ensure that the claims we are releasing through this settlement will not interfere with our ability to move current investigations and prosecutions forward, and to advance the work of the Financial Fraud Enforcement Task Force. So let me be very clear on this. While today's agreement resolves certain civil claims based on mortgage loan servicing activities, it does not prevent state and federal authorities from pursuing criminal enforcement actions. And it preserves extensive claims related to mortgage securitization activities, including the claims that will be the focus of the new Residential Mortgage-Backed Securities Working Group. Furthermore, the agreement does not prevent any claims by any individual borrowers who wish to bring their own lawsuits. This agreement underscores a point that many of you heard me make here at the Justice Department less than 2 weeks ago when Secretary Donovan and I announced and convened the first meeting of the Financial Fraud Enforcement Task Force's new Residential Mortgage-Backed Base Securities Working Group. I noted that by focusing on collaboration and by bringing our government's full enforcement resources to bear, we can improve our ability to identify and to prosecute misconduct in our financial markets, to recover losses, to prevent fraud, and to hold those who violate the law accountable. Today's settlement proves this and is a remarkable example of cooperative law enforcement. Multiple federal agencies, including DOJ, HUD's Office of the Inspector General, the Federal Housing Administration, the Federal Housing Finance Bureau, the Board of Governors of the Federal Reserve System, the Federal Trade Commission, and the Special Inspector General for the Troubled Assets Relief Program, all played key roles in achieving this settlement. And we partnered with state attorneys general offices and state banking regulators from across the country who brought valuable expertise and unique on-the-ground experience with those directly affected by the foreclosure crisis to this resolution. In particular, I want to recognize the outstanding work of the Justice Department's United States Trustees Program and our United States Attorneys' Offices. The U.S. Trustees Program, which serves as the watchdog of all bankruptcy court operations, was one of the first federal agencies to investigate mortgage servicer abuses of homeowners in financial distress. As part of their investigation, trustees reviewed more than 37,000 documents filed by major mortgage servicers in federal bankruptcy court and took discovery in more than 175 cases across the countries. Now, these efforts were advanced by several United States attorneys, including U.S. Attorney Loretta Lynch from the Eastern District of New York, who is with us today. During a 3-year investigation, her office issued multiple subpoenas, reviewed over 2 million documents, and interviewed numerous witnesses. They have worked tirelessly to seek justice for homeowners who were treated unfairly and taxpayers who footed the bill. And the information evidence that these teams compiled and the expertise that they provided was essential in reaching this historic settlement. Similar large-scale reviews were also conducted by HUD, FHA, and others. Our investigations revealed disturbing practices. For instance, we saw that far too often servicers pushed borrowers into foreclosure, even though federal regulations require the servicers to try other alternatives first. These failures didn't just hurt borrowers who might have been able to afford modified mortgages. They fueled the downward spiral of our economy and of communities nationwide. They eroded faith in our financial system, and they punished American taxpayers who have had to foot the bill for foreclosures that could have been avoided. With this settlement, we are recovering precious taxpayer resources, and the state attorneys general will be establishing a fund to facilitate payments to borrowers who, as a result of improper lending practices, lost their homes during the foreclosure crisis. Mortgage services also will be required to dedicate substantial resources, approximately $20 billion, to provide relief and assistance to struggling homeowners and neighborhoods. And the agreement includes specific provisions that will enhance protections and help ensure justice for U.S. service members and their families. I also want to note that with this settlement, we aren't just holding mortgage servicers accountable for wrongs that they committed. We are using this opportunity to fix a broken system and to lay the groundwork for a better future. Our nation's lending mortgage services will be required to follow a new set of standards, which will be overseen by an independent monitor and will be enforceable in federal court. My colleagues will discuss some of the details of today's settlements more specifically, and I encourage anyone seeking additional information to visit a new website that we have established, www.nationalmortgagesettlement.com. I want to thank everyone who contributed to this settlement, and now I'd like to turn things over to one of the leaders of this important work, my colleague in the Cabinet, Secretary Shaun Donovan.
Eric, thank you. And I want to thank everyone here on the stage, but also the countless folks who are here in the audience that worked so closely, so long hours, including into the wee hours last night, to make this day possible. And I want to return in a moment to talk about the remarkable work in particular of our state partners, the attorneys general. But I do want to single out in particular Tom Pirelli, who was just a relentless, magnificent partner in this work. Tom, thank you. Eric, thank you for picking Tom, putting him on this as a partner, and I really do want to appreciate all the work that you did together with my team. As Attorney General Holder just mentioned, this historic settlement will not only hold institutions that wronged families, neighborhoods, and contributed to the collapse of not just the American economy, but the international economy, not just hold them accountable, but it will also provide immediate relief to homeowners, forcing banks to reduce principal on loans, refinance loans for underwater borrowers, and pay billions of dollars to states that can be used for direct help to consumers struggling today. And it comes not a moment too soon for homeowners, for our housing market, and for our economy. We all know how the housing bubble burst, how lenders sold loans to people who couldn't afford them, and how they packaged mortgages up to make profits that turned out to be nothing more than a mirage. As we know, and we know that these actions hurt millions of families who did the right thing but still lost their house or saw their home prices drop through no fault of their own. But as the banks acknowledge with this settlement, and as HUD, state attorneys general, and banking regulators across the country heard from consumers in every state of this nation, those abuses didn't stop there. They continued long after people got the keys to their new homes. We know this not only because of the investigations that Attorney General Holder just spoke about, but because in the summer of 2010, long before the robo-signing scandal erupted into public view, HUD initiated a large-scale review of the Federal Housing Administration's largest servicers. Combined with the work that you'll hear about from our Inspector General and his remarkable team, between us, we devoted more than 15,000 hours to reviewing servicing files for thousands upon thousands of FHA-insured loans. And the scope of this review included not just the robo-signing conduct that has been so publicly discussed, but a long list of mortgage servicing issues such as lost paperwork, long delays, missed deadlines, or problematic loan modifications offered to homeowners. As HUD's Office of Inspector General found, the country's five largest loan servicers also routinely signed foreclosure-related documents without really knowing whether the facts that they contained were correct. In effect, many of the very same financial institutions responsible for so much of this crisis were making it worse, harming families, neighborhoods, and our economy. This settlement holds those institutions accountable for their actions. As you've heard in this core settlement we're announcing today, more than $25 billion in total. And that number could grow as we look to add additional institutions to this settlement. But this isn't just about punishing the banks for their irresponsible behavior. It's also about requiring them to help the people they harmed by funding efforts to help homeowners stay in their homes. And that's precisely what this settlement delivers, reducing the loan balances for approximately 1 million families who owe more on their mortgages than they're worth or have suffered in other ways. Principal reduction at this scale will not only help these underwater homeowners start building equity again, but also their neighbors who've watched their homes drop by $5,000 to $10,000 in value each time a foreclosure sign goes up in their neighborhood. The settlement will also help unemployed homeowners to catch up on late mortgage payments. It funds housing counseling services to connect at-risk families to the help they need, and it helps communities struggling with vacant properties that drag down neighborhood home values. And by instituting tough penalties and stringent timelines enforced by our respected and independent monitor, Joe Smith, banks have a strong incentive to provide this help quickly and effectively. The settlement also provides cash payments to homeowners who were victims of deceptive servicing practices. Now, we all recognize that you cannot undo the pain of this crisis simply by writing a check. But these payments provide victims with welcome and needed relief. One of the most important ways this settlement helps homeowners is that it not only rights past wrongs, but that it forces the banks to clean up their acts and fix the problems uncovered during our investigations going forward. And it does that by committing them to major reforms in how they service mortgage loans. These new customer service standards are in keeping with the Homeowner Bill of Rights announced by President Obama in the last few weeks. A single, straightforward set of common sense rules that families can count on when they're making the single most important purchase of their lives. And it requires lenders and servicers in this settlement, which just the 5 of them represent nearly 2 out of every 3 mortgage loans serviced in this country, to follow a long list of rights for those facing foreclosure. No more lost paperwork, no more excuses, no more runaround. And this is just one step in making sure we right the wrongs of this crisis. Indeed, last month, as Attorney General Holder mentioned, he and I announced, with many state partners as well, an investigation into the conduct of financial institutions that broke the law and led to the crash of the housing market, including securities and origination-related cases. So while it isn't designed to address all the issues of the housing crisis, it is a historic agreement. and a big victory for those who are harmed the most. Combined with the broad-based refinancing plan that President Obama announced to help homeowners last month and additional steps we've made to support principal reduction, it provides a path towards stability for our housing market and our broader economy. Banks and mortgage servicers expect that homeowners will meet their obligations under a mortgage. Homeowners should have the very same expectation of their financial institutions. And with this settlement, those institutions will be forced to live up to those expectations. Holding these banks accountable is what this settlement is about, and helping the millions of families harmed by this crisis. It's why I'm so proud to join all my partners today, and why I'm particularly proud to introduce not only Attorney General Tom Miller, but also to thank Attorney General Tom Suthers for their leadership in getting to this historic agreement. You know, many Americans have lost faith in institutions in this country and our ability to cross party lines and to put country ahead of politics. This agreement restores my faith, and I hope so many others' faith, that we can do big things regardless of party divisions and geographic lines. This would not have been possible without the early and relentless leadership of Tom Miller and John Suthers. I have come to call them friends and partners through this, and I recognize the remarkable work of their colleagues as well. But I need to single them out, and in particular, as I welcome Tom Miller to the podium, to say thank you for their remarkable, remarkable work. Many of the things that we need to do to help homeowners going forward will require congressional action. And I think we have on this stage an example of what can be done when we put country ahead of party. But we also, as President Obama has said, we cannot wait for that action. And this announcement today shows that we can do big things in this country across partisan lines and restore faith in the ability of our institutions to help families that need it most. So, Tom, thank you. Congratulations.
Thank you, Shaun.
John, thank you.
Thank you, Tom. Appreciate it very much.
This settlement is about homeowners, homeowners in distress, the people in our country that need help as much as anybody else. And that's what we have focused on, and that's what this settlement does. As outlined by the Attorney General and the HUD Secretary, there's a number of things that are going to help homeowners and help them a lot. But I want to talk about two aspects. One is the servicing standards. Comprehensive servicing standards, a real strong Bill of Rights of how they treat homeowners in distress. In the past, it's been a dysfunctional system. That homeowners don't get called back. That they put documents in and they get lost. The wrong decisions are made on loan modifications. People are foreclosed upon while they're discussing loan modifications. A dysfunctional system. This set of agreement, this set of guidelines, has the potential to change all that. And it's going to be incumbent on all of us to make sure that that potential is realized. We have the states, we have the federal government, we have a court decree, we have a monitor that we've never had before in this kind of situation, to make sure that they do what they've promised. And if they do, this, as Debbie Hagan of Illinois said the other day, it's a sea change in how homeowners have dealt with. And I say today to the banks, this is an opportunity for you. In your enlightened self-interest, this is an opportunity to change things for the benefit of your homeowners, investors, and yourself and your reputation. This is a great opportunity for them to do the right thing. This is also about, this agreement came about as a result of strong, healthy, bipartisanship relationships. The Attorney Generals, I think, have a rich tradition of being a bipartisan group, and that's never been more true than in this settlement. John Suthers, to my right here, led the Republicans, along with Rob McKenna, the Attorney General of Washington, and the President of the Attorney General's Association, sort of coordinated and worked with the Republicans. And Attorney General Pam Bondi was on this negotiating committee and worked a lot with the new Republican attorney generals. She contributed a lot on this. Roy Cooper of North Carolina, like me, a Democrat, was the steady hand in all of this as we went forward. Lisa Madigan of Illinois contributed oh so much to what we've done. Through Debbie Hagan, her remarkable assistant, and through her own leadership, and through her courage. You know, I don't think we probably see as much political courage today as we should, but we saw a lot with Lisa as she stood and supported and worked on this agreement under very difficult times. That's good stuff, Lisa, and we respect and admire you for that. George Jepson of Connecticut, who's here with us, was on the negotiating committee and did a great job. Attorney General Dustin McDaniel of Arkansas, Attorney General Doug Dantzler of Maryland, Attorney General Greg Zeller of Indiana are also here. They contributed in this effort as well. So we had this just great group of attorney generals working on a bipartisan avenue. And, you know, we must admit that we don't do all the work in the Attorney General's office. And we had a remarkable group of assistant attorney generals that coordinated, worked on this the last 16 months in just an incredible way, and of course also along party lines. And I'd just like to mention their names. Patrick Madigan from my office was the leader and was just remarkable. Debbie Hagan of Illinois, I mentioned Debbie. Matt Budzik of Connecticut, Phil Lehman of North Carolina, Vicky Butler of Florida, Jim DeRoss of Texas, Dave Huey of Washington, and Andy McCollum of Colorado. They were the workhorses on all of this. And then for the last 7 years, we've had another remarkable relationship. That's with the state banking regulators. We've worked with them on the AmeriQuest case, the household case, the task force to deal with and prevent foreclosure. John Ryan, their executive director, is here. Again, a great relationship. Party means nothing. And, you know, I keep trying to think of myself as a relatively young man, but I've been Attorney General for 30 years. And during that time, I've had been involved in a lot of multi-states that worked with the federal government in a lot of ways. And have had good relationships and sometimes not so good relationships working with the feds. That may surprise you, but it's true. But of all that time, I've never seen such a wonderful, effective, based on respect relationship as we've had with Tom Pirelli and Shaun Donovan. It's been truly remarkable. They treat us as equals. They roll up their sleeves. We get the job done as best we can together. It has been a model for federal-state relationships, the relationship that we've had with them. And just going back for 1 second to the assistant attorney generals, the attorney general's offices over the last 4.5 years since the mortgage meltdown in 2007, we have done more on dealing with, working with, prodding, pushing, threatening to sue the servicers of loans than anybody else. In terms of knowledge base on the servicing of loans in this country, us and the banking regulators, state banking regulators, I think are unparalleled in our knowledge and our experience and what we've done. Just wanted to mention that as well. But to conclude here, what we have done is do something that is very important for homeowners. At this current time, we're the only ones that were able to do the servicing standards and get them implemented now. At this time, we're the only ones, I think, that can deal effectively with principal reduction. And what will happen on principal reduction is briefly this, that this agreement provides for substantial principal reduction. And once it happens, something's going to become apparent. And that is all those things they worried about, the sky is falling sort of arguments about principal reduction. Guess what? It won't happen. And on the positive side, the redefault rate will be the lowest or among the lowest. And then, at that point, principal reduction will become a regular, common tool, I think, for everybody in this country. And to get there, this is the only vehicle to do it. And there is a precedent for it. It's on interest rate reductions. For 2 years, we kept telling the banks, you need to do interest rate reductions. You need to cut the payment or the loan mods won't work. They resisted that. Finally, as a result of a number of things that were done by the states and by Department of Treasury, they started to do principal reductions. It worked. Now it's commonplace. So this is just an extraordinary opportunity to help homeowners, one that is not present anywhere else in our configuration of state, local, or national government. And finally, I'd reiterate what I think Shaun ended with. I believe that the public wants us to work along party line, work across party lines, and to do things for ordinary Americans. And homeowners in distress are ordinary Americans that need help more than most others. This is exactly what the public wants us to do, and I believe we've done that. Work across party lines to serve the interest of ordinary Americans. With that, I'm delighted to introduce one of my colleagues that I have the most respect for. He's a terrific guy. He's a straight shooter. He's smart. He does the right thing. He's great to work with. John Suthers of Colorado.
Thank you, Tom. Appreciate it. Ladies and gentlemen, there are presently 25 Democrat state attorney generals and 25 Republican state attorney generals. So the question comes, how is it that 49 of those state attorney generals came together to agree on this settlement? The answer is quite simple. The attorney generals realize that this settlement is very, very much in the interest of their state and the citizens of their states. Well, why is that? States litigating with national banks pose some very significant litigation problems. Number one is federal preemption. And while there's been some clarification in case law and congressional legislation about that, it's still a murky world, and we would be litigating some of those issues for at least the next 5 years. Number two, all of us have very disparate consumer protection laws. Some of us, like my state, have relatively small limits on the amount of money that can be recovered for Consumer Protection Act violations that we would be proceeding under. So when all these attorney generals looked at this settlement as it's structured, they realized the bottom line was there's no way that without the federal partnership in this case could we have achieved the results that we have achieved. The notion, for example, of the states being able to impose servicing standards on a national bank, that wouldn't have happened. The notion of being able to utilize a monitor, that could not happen without the partnership between the states and the federal government. So the bottom line is they entered into this agreement because it's in their interest and the interests of their citizens. I want to say just a word. I'm not quite as old as Tom Miller. I may look older than Tom Miller, but I'm not quite as old as Tom Miller. But I have been practicing law for 35 years. And the vast majority of that, I've had the pleasure and the privilege of serving as an elected district attorney, as United States attorney, and now as the Attorney General. I've been involved in a lot of joint federal-state task forces, investigations, and whatever. And like Tom, I can tell you some horror stories. The conclusion that I came to many years ago is that so many of these, unfortunately but inevitably, are personality-driven. And the fact of the matter is, we had the incredible fortune of having this joint federal-state partnership driven by two people in the federal government that I have never seen anything like it, the extent to which Tom Pirelli and Shaun Donovan, as I said, didn't do any of that Fed stuff that we states see so often. They did, in fact, treat us as equal partners, and frankly, if I were them, I would have given up on us a long time ago. I mean, it was brutal. You know, first of all, the Republicans were off this way, then the Democrats were off this way, but with their patience, they brought this thing together, and I can't say enough about the perseverance and dedication that they've shown. So I'm on behalf of my Attorney General colleagues, I'm very proud to be up here today announcing what I see as an incredible example of federal-state cooperation. And now it's my privilege to introduce the HUD Inspector General, David Montoya.
You bet. Thank you very much. Good morning. I'm pleased to be here today with you to highlight the invaluable and the tireless work of my audit, investigative, and legal staff and their crucial role in enabling today's announcement on the multi-state settlement over mortgage loan servicing and foreclosure abuse and loan underwriting practices for mortgages insured by the FHA. I also commend the alliance of efforts between my office and the Departments of Housing and Urban Development and Justice, as well as the state attorneys general, to bring this matter to closure. If not for simple greed and inappropriate behavior that some at the corporate level of our banking and mortgage industry exhibited, many Americans would still be in their homes. I am proud that my office played such a critical part in addressing this harmful conduct. This settlement, the largest ever for HUD involving mortgage servicing and foreclosure abuse, benefits both distressed homeowners and the taxpayers of the United States. I want to assure all Americans that my office will remain vigilant in defending their interests. We are committed to aggressively pursuing those whose misconduct contributed to the housing crisis and those who flagrantly continue to do so. And thank you for that. At this point, I'd like to introduce to you the Attorney General from the great state of Illinois, Lisa Madigan. Lisa, thank you.
Today, we pick up another piece of the wreckage caused by the foreclosure crisis. As we've determined previously with salvaged pieces of this crisis, the bank's abuses in the mortgage servicing and foreclosure process were pervasive and preventable. Yet it took state and federal investigations and legal actions to stop these illegal, immoral, and often inhumane practices. The largest bank mortgage servicers deepened the despair for millions of homeowners and have stalled a recovery of the housing market. In Chicago, there are whole blocks of neighborhoods riddled with foreclosed homes and haunted by the lost opportunities of those who lived there. Know that this is neither the beginning nor the end of our work to hold banks and other institutions accountable for the destruction they've caused our families, communities, and country. Today's settlement should serve as a warning to financial institutions. There are consequences for engaging in practices that jeopardize the stability of our communities and our economy. And state and federal governments remain committed to continuing our investigations and prosecutions of all the players in the marketplace who contributed to the housing and economic collapse. I would like to join my colleagues, my state AG colleagues, in thanking all of them for their hard work and participation, but specifically thanking our Assistant Attorneys General for all of the hard work that they have done day after day, week after week, month after month during this investigation and negotiation. But not enough can be said about our federal partners. They have been absolutely incredible. They have stuck with us, as has been mentioned, and so my great thanks to the HUD Secretary, to AG Holder, and specifically to Assistant Associate Attorney General Tom Pirelli. Thank you. Let me introduce at this point the great Attorney General from the state of North Carolina, Roy Cooper.
Thank you, Lisa. State Attorneys General are on the front lines, and we heard thousands of complaints from homeowners. So here we are today with our state and federal partners. Strong, court-ordered enforcement with teeth distinguishes this deal from earlier efforts to help homeowners through this foreclosure crisis. This is a strong agreement, backed by a court order and financial penalties, and supervised by an independent monitor. The monitor will make sure the banks follow the rules. Former North Carolina Commissioner of Banks, Joe Smith, will serve as monitor. He and his team will look over the bank's shoulders to make sure that they meet targets for homeowners. I know Joe. He will be tough, he will be thorough, and he will be fair. If prohibited foreclosure fees are charged, if homeowners get the runaround for a modification, If homes are foreclosed before other options expired, the monitor and the courts can step in and make it right. Banks will be forced to follow a clear set of rules that will give a better chance to homeowners in trouble. This helps our communities and our economy. As immediate past president of the National Association of Attorneys General, I look at this state-federal partnership as a model for the future. We will continue to work together to level the financial playing field for consumers. And now to wrap this up is a guy you've heard a lot about. His negotiations sometime had to resemble hand-to-hand combat. But he did it with perseverance. And I want to introduce to you the Associate Attorney General, Tom Pirelli. Tom? Great work.
Thanks, everybody. I really appreciate it. Very kind words. I think, as has been said, look, in Washington you hear a lot about bureaucracies, about multiple agencies with overlapping missions, about turf fights, about battles between federal authorities and state sovereignty. But when you lose your home to a foreclosure, you don't want to hear about bureaucracy and you don't want to hear excuses. You want a government that actually solves problems. The resolution that we reached today shows what can happen when people put aside turf wars and focus on what they can do together to make things better. When the robo-signing allegations first surfaced, it was apparent that an alphabet soup of government agencies had various roles to play, and from state attorneys general to state banking regulators to federal banking regulators to all the federal agencies and investigative arms that support and enforce the law in the housing market in various ways. There were any number of ways that the government could have addressed us, and we could have addressed this, and we could have pulled at each other in all the wrong directions. Instead, we decided to work together. We began talking about and working together about all the different ways to solve the problems that we faced. We all had different tools, different perspectives, and let's be frank, different goals. But public officials on both sides of the aisle from across the country decided that we could do something together that would be better law enforcement, better housing policy, and better for the consumers who we serve. I think, as has been said, you will be hard-pressed to find a more effective state-federal cooperative effort anywhere. On the federal side, we had agencies with teams of investigators, open investigations, strong enforcement authorities, and deep expertise. And we joined with states that had long-standing investigations, on-the-ground perspectives, very different housing markets, and fantastic lawyers. And step by step, with a united front, we found our way. There are so many people that one could thank. Some of the agencies who have been extraordinary partners in this, the federal banking regulators, OCC, the Fed, and the FDIC, who have worked with us over time and I know are going to be issuing some orders of their own today and in the coming days. I think when a chapter of this history is written, one of the things that they will find is that the U.S. trustee program, represented here by Director Cliff White, and the Federal Trade Commission, represented here by Chairman John Leibowitz, were actually the first to recognize many of those issues. And if you go back in history and see the countrywide settlement that they negotiated some time ago, they were at the forefront of this, and they have been extraordinary partners, and I really thank them and appreciate them. The Treasury Department here, represented by Assistant Secretary Tim Massett, has been a tremendous partner, both with their deep knowledge of the housing market as well as understanding how we can best and most effectively help homeowners. A number of the state attorneys general talked about the extraordinary work of the assistants throughout the country, and I'd particularly like to thank Brian Houck from my office, who is just an extraordinary public servant who has worked tirelessly on this. And while people have said some nice things about me, they should be talking tenfold about his work, because he has been the glue, along with Patrick Madigan of Iowa, to hold this together. I think the last thing I'd like to say is our work will not be finished as we ultimately file this case as a consent judgment in federal court in the next few weeks. As the Attorney General said, we're going to continue to investigate and collaborate with our state and federal partners on issues related to mortgage-backed securities and other issues. We'll continue to work to make sure with the monitor that this settlement is fully enforced and it fulfills this goal. This team, the team you see here and many folks around the country and in the audience, is going to continue to try and ensure that we obtain complete redress for all the harm brought to the American public in the housing crisis. So thank you very much. And with that, I think we will take some questions.
For Mr. Attorney General Miller, please. Mr. Attorney General, not to dismiss how hard this deal was and the complexity involved, but when you look at the actual average relief on the principal reduction side and on the cash payment to foreclosed homeowners, it's a bit low. And those homeowners may well ask if you settled low.
I'd look them in the eye and say no. And here's what I would tell them: that this agreement has more things to help homeowners than anything that we've seen before and probably ever will see again. And on the principal reduction, let me make the point that I made before. I believe that this agreement will eventually make widespread principal reduction throughout the country commonplace, for the reason I said, that there's going to be a significant amount done right away. Particularly a Bank of America is going to have a wide open plan that anybody that meets the basic criteria of a very large pool can get a principal reduction. And once this demonstration of principal reduction takes place, it will work and it will become commonplace. And this agreement is the only thing out there that has any kind of a chance to get to that place of principal reduction. So in terms of homeowners that want principal reduction, this is the vehicle. In terms of the other benefits, you know, $3 billion for refinancing of loans. For the people that are forgotten. They're the people that are underwater. Their mortgage is greater than the value of the home. They make their payments day in and day out, the weekend and month in and month out. They meet all the other criteria to get a lower interest rate, but they're blocked because the home's underwater. They can't get a refinance to a lower rate. That's unfair. This breaks that unfairness, and I don't think those homeowners would tell us we've settled too low. And on the borrower payments, that's a really very small part of this. It's $1.5 billion out of 25 billion. And the context is this: that if you were foreclosed upon in the last few years, and you can point to anything wrong that the servicers did, lost your paperwork, missed a deadline, then you can get this payment of $1,500 to $2,000. These will go to people that could not recover in any other way. If they sued, they couldn't recover. It also will have a situation where if they find out later they could have recovered, they're not giving up any legal rights. So in that context, that homeowner that couldn't have get any relief, couldn't get $1, and they're getting a check for $1,500, they're not going to tell us we settled too cheap. This is a strong, balanced agreement. It's got a lot of other things almost hidden in there that will help homeowners. One of the really great things is that if people are eligible for a loan modification, the banks won't screw up those decisions anymore. There's teeth, there's regulations in there to make that happen. That homeowner's not going to say it was too little. Sometimes they're charged fees that they shouldn't be charged. There'll be the monitor looking at that. And if they find that fees are being charged that shouldn't, and there's an indication that it's widespread, the monitor will go and get those fees back. No new lawsuit, no new regulation. Bang, right part of the monitor. So those people are not going to tell us we settled too cheap. This is a strong, creative agreement that's going to help owners in significant ways, far more than anybody else has in the past in this context, and I predict far more than anybody will in the future.
Let me just add two things to that, because I think there are two specific misunderstandings about this that have contributed to this question here. One is that the math of this, given the complexity of it, I think there's been some misunderstanding about. And just to be specific, many people are taking $20 billion in expected homeowner relief, which is the portion as $5 billion in cash in the piece that we're announcing today, and $20 billion in benefits to homeowners, dividing that by the number that folks have heard of $1 million and saying, well, it's about $20,000 a homeowner. That doesn't sound like much in the context of people who are underwater, $30,000, $40,000, $50,000. The way that this will work is we will be crediting the banks against their requirements not for best efforts. They're requirements to actually reduce principal, actually deliver benefits. But we won't be crediting them dollar for dollar. If a loan is highly delinquent and the bank wouldn't rationally be able to expect to collect on that loan, we're not going to give them $1 of credit for writing off $1 of that loan. We're going to give them far less credit. And so in the end, what we are likely to get in terms of actual principal reduction is in the neighborhood of $35 billion out of the $20 billion in consumer relief. And so the math is actually much more significant than many have been reporting in terms of the direct benefits of the principal reduction. We'd be happy to go through the specifics of that. We have available state by state what's expected that adds to that total. But that's very important here. A second thing, and this ties to what Attorney General Miller said, the portion of this that is for homeowners that have been wronged, the restitution portion, was always designed to sit in parallel to a separate process that has been set up by federal regulators as a result of consent judgments. And the idea of that process is a homeowner can come in, have their claims reviewed at the cost of the banks, and full compensation is made for the wrong at the cost of the banks. Doesn't have to go into court. That process is now, it's set up and it's running. So the idea is there are many small wrongs that were done here that might have cost homeowners a few $100s, a few $1,000s. The idea was almost as in a class action, not to have to make every one of those homeowners come in, work with a lawyer, prove extensive harm, but to award them restitution as a class. That does not impede in any way their ability to go into this separate process. And if they were wronged by $200,000 because they lost their house, they can collect that from that process. So again, the misinterpretation is this is somehow all that will be available to those homeowners. It's not true. These two separate but parallel processes are set up and kind of designed together. So I think that's critical. Last thing I would say is, go back to my comments earlier. In the end, it wasn't the servicing practices that created the bubble nor caused its collapse. It was the origination and securitization of these horrendous products that created it. There is no question that the servicing practices that are issued today furthered that damage substantially. But even though there were hundreds of billions of dollars of harm done in the crisis, the wrongs that we are righting today are a piece of that. And we believe strongly, and we have done extensive research to see what we could have recovered if we won every suit that could be brought under this. And we believe this settlement is an extremely good settlement in terms of recovery for the claims that we're releasing. And just to be clear, no GSE loans, Fannie and Freddie loans, are at issue here. They represent about 2/3 of the market, right? None of those claims are being released. No criminal claims, no claims related to civil rights of any kind. The origination claims of FHA, the GSEs that are enormous claims, in addition to the securitization claims, we're retaining those. And so you have to look at this in the context of what's actually being released and being solved today. And that's why it's so important that, as the Attorney General said, as we announced our task force, that makes a very clear point. We are retaining those rights and that we're going to be aggressive about going after those claims going forward.
Can we follow up on that, though, sir? You were just saying that the banks now, it looks, may be ending up paying something closer to $40 billion?
I didn't say that. I said the benefit to homeowners, the direct benefit to homeowners, will be larger than, and just to take a, I'm sorry, go ahead.
What I was going to get to, though, is from the banking side of this, some of these banks are still struggling to recover from the financial crisis. Do they have the capacity to make these fixes, to pay this money? Could some of them, have they reserved already for some of these payments? I mean, are you concerned at all that this could hurt the financial health of some of these banks?
There is no question that there are reserves that have been taken. This process obviously has been extensive. We have had lengthy discussions, and reserves have been taken, I believe, at all of the institutions that are part of this, and even some institutions that we're discussing these claims with, but are not part of the announcement today. So we believe that is the case. But look, in the end, one of the critical things about this is, and to repeat Tom Miller's, principal reduction is an important part of steps that we need to take, and they include steps like the refinancing plan that the President announced and the work that we've done with Fannie and Freddie to refinance. Those are steps that will help our housing market recover. And the benefits not only to homeowners and the broader economy, but to these very institutions themselves are enormous if the value of properties across the country begin to rise as a result of these actions. And so in the end, we believe that this announcement is not just good for homeowners and the economy, but ultimately will help the financial institutions in the end. While there may be obviously short-term impacts to their balance sheets, those have been reserved for, it is critical for all of us to be able to get the housing market accelerating in its recovery.
On the GSEs you mentioned, are Fannie and Freddie loans exempt, or is it just the future claims aren't, and is it ones they own or guarantee?
So Fannie and Freddie, through the FHFA, have a separate process of enforcing servicing violations. And so in that, they will be, and they are pursuing those claims, and they have separate processes, as FHA does, for origination violations, et cetera. Specifically on which loans this will apply to, we see the refinancing portion that is part of this settlement as a perfect complement to the refinancing efforts that the President has already talked about and that are moving forward for underwater current homeowners in Fannie and Freddie loans. We knew, as we were designing this settlement, that we'd already made steps to make sure that Fannie and Freddie borrowers who are underwater and current could refinance at record low interest rates today, but we knew that that option was not available to homeowners that had loans that were in the portfolios of the banks. And that's what the refinancing component is focused on, so it complements what's available to Fannie and Freddie borrowers. On modifications, Fannie and Freddie are already doing extensive payment modifications for those homeowners. They are not, to date, doing significant principal reduction. This settlement, because Fannie and Freddie are not part of it, cannot require that they do principal reduction. But the President announced just a few weeks ago steps that will make, for the first time, Fannie and Freddie eligible for incentives to do significant principal reduction. They are evaluating that as we speak. And we look forward to taking additional steps that could make principal reduction available to Fannie and Freddie homeowners.
And Shaun, the servicing will apply to
Very, very important point. We worked very hard to align these servicing standards and to bring Fannie and Freddie on board. So the servicing standards do apply across the board, not just to private label securities or portfolio loans for the banks, but also to Fannie and Freddie loans. It's a critical point, Tom. Thank you.
I had a quick follow-up on the point that Mr. Barnes, I believe, made. Is there, of the $17 billion in credits, is there a maximum amount of those credits that can be earned by modifying loans in mortgage-backed securities?
There is not a cap on that. There has been a lot of misunderstanding about this issue, and so let me just try to clarify. There is a dramatically lower credit, if you will, for principal reduction for investor-owned loans, or also called service for other loans. And we expect, of the principal reduction that gets done, and principal reduction on first and second loans that keeps families in their homes, so not short sales or other, but principal reduction just to keep families in their home, is a minimum of 60% of the consumer menu that's available. We expect a relatively small share, in the range of 15% of the principal reduction, to be done in serviced for others loans. There is a special kind of effort that Bank of America will make as part of this agreement, where they have agreed to do deeper principal reduction and to solicit every single one of the old Countrywide homeowners. About 80% of those are private label securities loans, and as you may be aware, they've already made a substantial payment, or agreed to make a substantial payment to investors in those loans. So our expectation is that the vast majority of private label security loans that are reduced in principal as a result of this would be the old Countrywide loans, and investors are being compensated on those loans. But also, let me just be very clear. There's clear language in this document, in the settlement agreement, that says nothing in it requires any trustee or servicer to reduce principal where it's not allowed legally by the underlying documents, nor where it's not net present value positive or in the interest of those investors. So the misunderstanding somehow that investors will be paying the bank's share is just false. This is real penalties for the banks, real costs for the banks, and the vast majority of loans are going to be in the portfolios of the banks anyway, where the principal is reduced.
If I can just...
Right?
There's no max. But let me try and clear up just a little bit of confusion. Some writers, perhaps you, have written that when investors' loans are modified by principal reduction, the investors will lose money, and that's unfair to them. That reveals, and it's not only you, but a very prominent United States senator who I have a lot of respect for, wrote a letter saying the same thing. But that totally misunderstands principal reduction. Principal reduction is an effective way for everybody to win. And when I say that, I mean this, that there are some homeowners that can't make the full payment, but they can make part of it. And the part that they make is more than the investor would realize under foreclosure. So it's in everybody's interest to do that modification. The homeowner stays in his home, the community is protected, the investor gets more money by the modification, not less money. That is what principal reduction is all about. And that's the fallacy in some of those stories and the letter by the senator. This is something that we in Iowa know very, very well. We had a terrible farm crisis in the 1980s, and our whole farm community was being torn asunder. And we came up with this idea of loan modifications. And the head of the Bankers Association in Iowa went arm in arm to the legislature, the two of us, and got legislation passed so that there was required mediation before there could be a foreclosure. And that was the vehicle to get to this win-win situation. And farmers, many farmers, stayed in their homes. The investors realized more. And when we saw this crisis coming for homeowners, we said, we've seen this before. And that's why Patrick Madigan and I and others in 2007 went to the banks and made this appeal to do loan modifications, both interest rate reductions and principal reductions. It's a win-win-win for everybody in the right set of circumstances. And guess what? What's designed in this package is exactly looking at the right circumstances.
Will the banks get credit will the banks get credit for prior modifications or principal reductions?
They will not.
When will they?
I think it's is it the signing or is it the consent decree? It's soon, but not yet.
Thank you.
Nice job, huh? It's been great working with you.